There we go. I'm not sure that recorded anything. There we go. Give me a quick comment if you could. My computer is acting funny. Did anybody hear anything that I just said? Did anybody hear anything that I just said? I've been talking for about a minute now and realized that on the stream that it may not have been coming through. Can somebody chat me real quick and say that you've been hearing me the whole time, or you just now, like within the past 15, 20 seconds, started hearing from me? Anybody? I see Sarah, you're on there. Thank you for saying hi. Let me know. Okay. Awesome. I love technology. I love when technology works. So let's do another cut. All right, my famous clapboard there. So I don't know what the heck was going on there. Frustrating technology. Anyway, here we go again. Hello, everybody. I'm Brian Lee. I am your webcast host. Oh my goodness, it's going to be a good day, I promise. We are talking about mortgage financing stuff. With the webinar, we just, or rather in class last night, several of my students, we started into chapter 19, which for some of you are like, we don't even know what that is, and that's fine. But our chapter 19 gets into mortgages and financing and all that. And what I really hit on at the beginning of that chapter, something that you really need to know for your state exam, is to go through this. On our exam, on the exam that we have that we put out for our class, on this particular section of the course, it is nearly 1/3 of the entire exam. So it's a pretty big section just in general. On your exams, in the Indiana State exam and probably throughout the country, I'm pretty confident in saying this, that you're going to see a lot of terms. It's not the entirety of the exam, obviously, but there are a lot of things, a lot of terms, a lot of definitions, and there is math too. So there's a lot of pieces that we have with that. So again, just wanting to reinforce how important this section is, that you understand the terms, that you do know the definitions, that you are going to be able to work through and do some of the math calculations. And don't worry, I have some math questions for you, so don't think I've forgotten about you. Those of you that are worried that I didn't have math, don't worry, I've got it for you. So we'll cover all that. So starting off, in today's section is just kind of a sliver of all the terms. Certainly future episodes, we will have more terms. So this is not a comprehensive list anywhere near it. This is just a sliver of it. There's going to be more in the future. Our podcast have some of these terms. Our website has these terms. So make sure you're going through all of them. But today we're just getting into a few to kind of start the conversation. So the first topic, the first thing we want to get into is there on, I guess, again, I always say I'm not sure which way you're viewing it, but to my left, if you will, it might be to your right, but on my screen is to my left, the key terms there in that white box. So the first one is PITI, P-I-T-I. Make sure you know what that is. PITI is going to be the mortgage payment that you have in most situations. There might be a few types of loans, and when we have future episodes, again, we'll cover something called an interest-only loan, a straight loan, things like that, where maybe you don't have all these pieces. But the PITI payment is going to be the most typical scenario. Doesn't matter whether we're talking about a conventional loan, an FHA loan, a VA loan. Essentially, we're talking about an amortized type of loan where you have 4 pieces that are part of that. So that's what this acronym is, PITI. The P stands for principal. The principal is the amount of money, the amount of your payment that you make every month that goes to paying down your debt. So you borrowed $300,000, and this part of your payment, of the principal payment, goes to pay that down. So let's say that $400 of your payment that you make every month. It's not that your payment is $400. Your payment might be $2,000, but $400 of it goes toward your principal. So you borrowed $300, and now after your first payment, you owe $299,600. You paid it down by $400. So that principal pays down what you borrowed. The first I in that acronym is interest. That is the interest that the bank is charging you. That's the profit, if you will. That is the cost to borrow money. So we'll get more into that here in a little bit, as you can see further down the list, but that's what that I stands for. you might, or the T in the acronym stands for taxes, and the second I stands for insurance. So both of those elements, the T and the I there at the end of PITI, those are your property taxes and your property insurance that are not prorated, I'm sorry, they are calculated, and it's a forced type of savings. So what we have here is a situation of where you have property taxes that you're responsible for paying. You have property insurance that you're required to have for the mortgage. You have to pay those things. One of the things that mortgage companies do in most situations is force you to save for those payments. So making the math very easy, just so that you kind of understand the concept here. Let's say that your taxes are $1,200, $1,200 a year. That's how much your taxes are. So what the lender would do is take that $1,200, divide it by 12, and say that you have to pay us $100 a month that we are forcing you to save, and that after you've made 12 payments to us over that year, you have now saved up $1,200. And then when your tax bill comes in, now we pay it for you. So the T and the I there are a forced savings. It's your money. It's not money that the bank gets to keep. They are saving it for you. They're forcing you to save it. And then when your tax bill comes in, when your insurance bill comes in, then they've got the money that they've been saving for you through your payment, and they make that payment for you. So that's the generic or very basic way of looking at what a PITI payment is. The next thing that you get into here, or the next acronym, is DTI. Valerie, thank you. I just saw Brian is the best. Can you tell my wife that? Can you tell my wife? Because I feel like maybe sometimes she doesn't hear me when I say that. And everybody else in the peanut gallery, yes, Sarah, I'm talking to you. You can just go ahead and do the screenshot and let her know that. Anyway, getting back on topic, the second acronym is DTI. It's the debt to income ratio. You will almost definitely see this on the exam. What we're looking at here is, or rather what this is it's something that a lender works through to qualify you for a mortgage. So there's a lot of things they take into account. They look at your income. They look at your expenses. They look at work history. They look at your credit score. They look at your down payment. But then they also look to see what is your income in relation to the debt that you have, the other debt, your mortgage, but also you have car loans, maybe you have credit cards, maybe you have student loans, things like that. So the debt to income ratio is a calculation that the lender will go through to figure out, and using their numbers, what they think, or rather whether you qualify for a loan based upon this calculation. So we're not going to do the math today, but I do want to work through the process so that you understand that, because you'll see questions that kind of address it in different ways. And if you stick with these concepts, you'll be able to apply the math pretty easily, because the math is very straightforward. I mean, we're literally talking about just taking a number and then subtracting the elements from it. So for example, let's say that you have an income, and let's say that income is $5,000 a month. That's how much you're earning that the bank uses in the qualification process. So we take that $5,000. Well, what they'll do is they will apply a debt to income coverage ratio to that, which is a big word for basically just them coming up with how much do they think of that $5,000 that you can use to pay toward all the debt that you have. So let's just make up a number and say that it's 40%. So in that case, $5,000 times 40% equals $2,000. That's how much money, the $2,000 is how much the bank will qualify or use to qualify you for your debt. So they're going to then subtract from that $2,000 number all the debts that you have. And this is an important part that you hear me say. We're talking about debt, money that you have to pay to somebody else as regard to borrowing of money. So again, we're talking about your mortgage, but we're talking about your credit cards and your auto loans and your student loans, anything where you have a financial responsibility to pay to somebody else. That gets deducted from this $2,000 number. So let's say that you have the car payments and you have the credit cards and you have student loans, and all those added up equals $900. So what they'll do is they'll take that $2,000 number that from that debt coverage ratio that we calculated earlier. We'll take the $2,000, subtract the $900 of debt that you have to pay, and that will leave a balance of $1,100, which is now the amount that you can apply toward approval for a mortgage payment. So now the lender's going to say that as long as the home that you're wanting to borrow has a payment of $1,100 or less, we will qualify you for that. But if the house that you want, with the debt that you have and the down payment that you have and all these other pieces, if it's more than $1,100, you do not qualify. Now, the last piece that I want to make sure you know about the debt to income coverage ratio and this calculation is that it doesn't include all expenses that you have. It only includes the expenses where you owe money to somebody else. So on your questions, watch for this, because groceries, utilities, cell phone bills, daycare, things like that, they are expenses to you. They are expenses that you have to pay for, but they are not included in this calculation. It is only for debt that you owe. So debt meaning that you've borrowed money from a bank, that you've borrowed money on a credit card, you've borrowed money for student loans, for car loans, whatever it might be. It is not for living expenses. So if on your exam questions, they say you make that $5,000, you have that 40% debt coverage ratio, which equals that $2,000 number, and they throw out all this list of expenses, and some of it's some of it's car and credit cards and all that, but then they also say you have a $200 grocery bill, you have a $150 electric bill, that your cell phone bill is $100, whatever it is. Those living expenses are not included in here. It's only for debt, money that you owe to somebody else. So make sure you know that. The next piece that we get into then is equity, which equity is something else that lenders look at, but also kind of taking a little bit of a tangent, that this is something that owners or homeowners also consider. So equity is relatively simple, but I'm going to test you on with a couple questions here in a minute on what equity is. But generally speaking, equity is the value of your home. Let me make sure I'm saying this right. The value of your home, and then deducting the amount of money that you owe on that home. So let's say that your home has a value of $200,000. Now, the first thing is, where does that number come from? Where does that value number come from? It could be the purchase price. You're buying the home for $200,000, so that would be the value of your home. It could also be the appraised value of the home. So watch the questions on the way they're presenting it. So depending on the situation, it might be the appraised value. So the value of the home is it is what it is. It might be the purchase in certain transactions, maybe in a different transaction. For example, a refinance where you're not purchasing the home. I already own it. Now I'm just refinancing it for a rate, a term, to borrow some cash or whatever that might be. Now we're looking at the appraised value. And I've got a question. We'll work through that here in a little bit to kind of show you that. But at the end of the day, we're looking at that value. Then we're subtracting how much you owe. So the home was worth $200,000 and I owe $160,000. That's how much I owe to the bank. I call up the bank and say, hey, bank, I've got a loan with you. How much do I owe you? And they say it's $160,000. So that difference there of $40,000 is my equity. So the equity is the difference between the value and how much I owe. So watch that number, because again, it's not too complicated, but they will throw different terms in there like appraisal, and your balance used to be 180 and now it's 160. So they'll try to trick you, but we're looking at what is the current value and what is the current debt that you owe on it. So look for those two numbers, and we could throw out the other pieces that just are there to confuse you. So that's what equity is. And again, I'll have a question for you here in a minute. The last three terms are kind of all tied together, so I don't go through them real quick, but at the end of the day, they do all work together. So the first term, the next term, the fourth term in the list, is the term promissory note. Promissory note is going to be the note, the document that you sign. It's essentially a contract. that a borrower signs that says that I promise to pay you, I would say pay the lender back what I've borrowed. I promise to pay. I promise that you're loaning me this money. I'm buying this home and you're giving me that loan for $180,000. This note that I am signing, this contract, this promissory note, says that I'm going to pay it back to you. And more specifically, it's going to outline all the terms that I have committed to. So it's going to say that I promise to pay you back at 4% interest. I promise to pay you back monthly and it's due on the 1st. I promise to keep up with insurance. There's a lot of promises that I have in here. And so that's kind of what we're getting into on these next term, or on that next term is interest, is that I'm going to pay you some interest. So the promissory note is essentially an IOU. I promise to pay you. You might see on your exam, I don't know if you will, it's something that we talk about or see somewhat often in the real world, is something called recourse debt versus non-recourse debt. So you'll want to pay attention to that. So this is kind of a subset of a promissory note. These are two different types of promissory notes. There's recourse note and there's non-recourse. A recourse note is one where I am personally responsible for this debt. So if the payment doesn't get made, bank, lender, you can come after me personally for recourse. You have recourse. You can do something to me. And when I say do something to me, I'm not talking about physically. We're not sending some goon out and going to beat me up. I'm saying that they have some legal action against me. That's what recourse debt is. Non-recourse debt is, as you can probably put together now, says that I am not personally responsible for that debt. If the payment doesn't get made, you can't touch me. Non-recourse debt says you can't touch me. I am not personally liable for that debt. So that would be in the promissory note too, to say that this is recourse debt. This is a recourse note, meaning that, Brian, we're coming after you. The payment doesn't get made, you're personally liable. Or the note says this is a non-recourse debt. The payment doesn't get made, Brian, we can't touch you. There's nothing we can do to you. There's other things that we can go through. We can foreclose on the property, but we can't touch you. There's no personal liability. So make sure you're watching for that. Interest, as we've been talking about, is basically just the calculation that the bank uses to show that, or not to show, but to earn their income, to earn their money, that they're going to have some charge. And we'll work through some calculations on what that looks like here in a minute, along with some payments. But interest is that charge for the use of money, the amount of money that the bank is loaning to you. So one of the things that we want to talk about here in this conversation is that when we're working through any math calculation for mortgages, it is always, including interest. This is very important with interest and all the questions. Make sure you hear me say this, that every time we're doing a calculation, these mortgage calculations, everything is based upon what you are borrowing, How much do you owe to the bank? It is not necessarily, in fact, in most cases, and watch this for your questions, it is not what you're buying the home for. I might be buying the home for $200,000, but I'm getting a $180,000 loan. So all the calculations, the interest calculations, everything, when we're talking about mortgages specifically, everything is always based upon how much I am borrowing, not what I'm buying the home for. Now, we will, in a future webinar and certainly a future podcast, we'll talk about loan-to-value ratios, and there we will have to talk about purchase price and all that. But as far as interest, bank charges, all the cost of borrowing money, which interest is, they are always based upon how much I am borrowing. So I need to know that number. Some questions will just flat out tell me that I am borrowing $180,000 or $160,000 or whatever the number is. It will tell me what that number is, so it makes it very easy. Some questions are going to say that I'm buying the home for $200,000, but I have a $20,000 down payment. So I have to do a little bit of math there. It doesn't tell me directly what I'm borrowing, but it said that I'm buying the home for $200,000. I have a $20,000 down payment, which I then have to understand and infer that what I'm doing is I'm borrowing $180,000 to buy that $200,000 home. And when I borrow the $180,000, I put my $20,000 down payment. There's my $200,000. But when we're doing the calculations, all of them are based on the loan amount. So in that case, it's going to be the $180,000 number. So make sure you do that. The last term that I have for you today is usury. Usury is tied directly to interest. And what that is usury is a law that is established in every state that says that this is the maximum amount of interest that a lender can charge for any particular loan. So I'm totally going to make this up because it changes from state to state and loan type to loan type depending on the jurisdiction. But usury might say that that in your particular state for this type of loan, the bank can't charge more than, let's say, 12%. And again, I'm making up that number, but let's just say that that's what the law says. It can't be more than 12%. So any lender out there in the entire state that wants to loan money for this type of loan, they cannot charge anyone more than 12%. And as long as they keep under 12%, they're within the confines of the law and they're doing fine. If a lender says to you, you're a borrower, and says, we're going to charge you 13%, we're going to charge you 14%, they're charging you above that state mandated number. We call that a usury rate. That's a usurious type of loan, and it is illegal. A bank cannot charge more than what the usury law says. So it's not important to know that it's 12% necessarily or 14% because it does change, but just know that every state is required by federal law to have a number, to have that interest rate, whatever it is. It might be 15%, it might be 20%, it might be 30%. I don't know because every state is different, but whatever the number is, the lender cannot charge more than that. And if they do, they have broken that usury law. They've gone above what they can legally charge. So watch for that. So those are your terms. Now, you ready for some questions and some math? Get out your calculators. First one, I'm going to let you get by pretty easily, but here's some questions for you to work through. The first one, very simple, softball, working your way into this a little bit. The question is, pity payments may include all the following except what? So pity payments, remember what that is. So we have answer A is principal, property taxes, and loan interest. B, loan interest, property insurance, and taxes. C, property taxes, interest, and commission expense. D, property insurance, principal, and mortgage insurance. What do you think? So pity payment includes all the following except. Now, one of the reasons I threw this question out is that a very, very common mistake that people make on these questions is that they're looking, your brain is programmed to look for the right answer. Well, if I'm going through this quickly, I'm saying that pity payments include all the following. And I'm looking at answer A. Pity payments do include property taxes, loan interest, and principal. So my natural inclination is my brain saying, hey, A is the right answer because that's right. That's what it is. But read the question. It says all the following are true except. So you have to stop your brain for a minute and say, hey, brain, I'm looking for the answer that's wrong here. It's the correct answer, but I'm looking for the one that is not true. Because the question is saying which of the following, may include all the following. So answer A, answer B, and answer D are all correct because I can do that. But the question is saying which of the following can I not do? That's what it's asking me. So I'm seeing all of you plug in C there, and you are all exactly correct that the answer is, in fact, C, because commission expense is not part of the pity payment. So I threw you the softball, but it was also thrown to you because I wanted to make sure. This is one that so many people, they kick themselves because your brain, the way your brain is programmed when you take the question or when you're reading the questions and you're taking the exam, you tend to want to find the right answer. And A, B, and D are all right, but they're not asking for the right one. They're saying which one of these is not right, and the answer is C, like you guys did. So good job. All right, next question. A borrower's debt-to-income ratio is an important metric to qualify that person for a loan based upon their overall recurring debt compared to their gross income. So we've talked about that a little bit. All the following would likely be included in that debt-to-income ratio except what? So which of the following rewording the question, if that helps you, which of the following am I not going to include in the debt to income? That's what it's asking me. It directly is saying all the following would be included except, but I'm rewording it in my head, say which of the following is not included. So as I'm going through there, my mortgage payment, that's going to be included. My auto loans, look at you guys, you're getting. I just need to stop talking now, don't I? In fact, let's just turn off the webinar. You guys got this. You got it unlocked. You were worried about it. You got it. Okay, maybe not. We'll see. But anyway, you are all correct. The answer is C, mortgage utility cost. Or I'm sorry, I said mortgage. Monthly utility costs. I can't even read my own typing. Monthly utility costs are not. That is not a debt. It is an expense. It is something I have to pay to be a homeowner or as a homeowner, but it is not included in that debt to income ratio. So the credit card payments, auto loans, and mortgage payments, those are all included. But Lons, I'm not going anywhere, I promise. Living expenses, utilities, groceries are not included in this. So watch for that. All right. Now, I promised you some math. I just saw a question, Sarah. I did not see your question, Deja. I'm sorry. Did I miss a question up here? What is it for Indiana currently? Again, it is going to depend on the type of interest. The last that I checked, and again, it's all over the board, but for most loans, it's like 21 or 24% to answer your question. In Indiana, it's around 21 to 24%. But again, that's for all loans. That's for credit cards. That's for car loans. That's for the check into cash places. That's for mortgages. It's for a lot of things. It's not just for mortgages. But Sarah basically hit the nail on the head there. It does depend on some of the variables. So yeah, I just saw your question. Thank you. All right. Gave you guys a little bit of time while I was answering that question for you to go through this one. Buyer Smith purchased a home for $148,000. Okay, I'm paying attention to that. With the help of a mortgage for 90% of the selling price. 4 years later, the balance of the mortgage was $129,000. An appraisal of the home at the same time estimated the value of Smith's home is $163,000. Excuse me. So Smith's equity in the home is what? Man, they threw out a bunch of stuff there, didn't they? A bunch of stuff. You know what? As I'm reading through this, do I even need anything in that first sentence? Do I need anything in there? If I'm going through that, I don't need any of that, do I? None of it. Because what they're saying here in the next sentence, it's saying 4 years later. So it's great that I recognize that I bought the home for $148,000. That's interesting. And that I got a mortgage of $90,000 4 years ago. So I can work through that calculation. And I promise when I do that, it's going to be one of these answers, but it's going to be the wrong one because the first sentence is all about what it was 4 years ago. For equity, I need to know what it is today. I'm talking today, not 4 years ago. 4 years ago, it was worth $148,000. 4 years ago, I borrowed 90%, so I can work through that, and my equity was $14,800, which is answer A, but that's not right. Read the question. 4 years later, the balance was $129,000. So now I know what my debt is, and it's telling me that the value of my home today is $163,000. So I'm seeing you all do it. Fine, you all got it correct. The answer C, because I'm taking the current value of the home. The current value is $163,000, not the $148,000. It was worth $148,000 4 years ago. Today it's $163,000. And they told me that my balance today is $129,000. So $163,000. I just saw in here. I'm so sorry. It says times. I need to change that. It should be $163,000 minus $129,000. Yeah, times 120. Don't do that. I'm sorry. The answer at the bottom, or the equation, is wrong. It should be $163,000 minus $129,000 equals $34,000. So the correct answer is C, $34,000, but that should be a minus sign, not a multiplication. My bad. Sorry. Yell at me all you want, but that's what it is. So 163 minus 129 equals 34. Good job, guys. All right. Next one. This is one that I wanted to throw in here because it dealt with interest. We will talk about this again in chapter 20. I did not skip it. I just wanted to throw this out there because it's one that dealt with interest itself. which was part of the conversation for the webinar today. So I wanted to make sure you knew this, and I'm not expecting many of you to know this answer. Some of you, if you've been through the classes already, you should know this answer. Some of you I see on here we have not covered this yet in class, so I wouldn't expect you to, but still, make sure you know what this is. So the question is, loan interest is charged by whom? Is it FHA, VA, USDA, or federally chartered banks? And the answer, I'm seeing a couple of you come up with it, the answer is D. And the reason I wanted to bring this up is just so that you understand this. And again, we will cover this in more depth in a future episode, but FHA, VA, and USDA, none of them charge interest. So many people think that. Some people say that I'm getting an FHA loan. You are not. You're not getting a VA loan. You're not getting a USDA loan. What you are getting is this. FHA and USDA give what is called, they don't give. What they do is they insure loans that federally chartered banks make. So all of these loans, FHA, VA, USDA, and federally chartered banks, they all are loans that are made by federally chartered banks. But an FHA loan, a USDA loan, they are insured by FHA. They are insured by USDA. They are not charged interest. They are not an FHA loan. You do not make payments to FHA. You do not make payments to VA or USDA. And VA, just for the record, or just for the clarity, they do what's called a loan guarantee, which is effectively an insurance type of program, but it's not. We'll talk about that more. But FHA, VA, USDA, they do not make loans. They insure or guarantee. They promise that if the borrower doesn't make payments, they're basically promising to the bank that we've got your back, but they do not make loans, so they do not charge interest. Only federally chartered banks charge interest in this question. So FHA, VA, USDA do not charge interest. Do not think that. Only think of those three entities, FHA, VA, and USDA. They are guarantors. They promise to pay the bank back if the borrower doesn't make their payments. So that's what they do. They insure, they guarantee, they do not give loans. So I want to make sure we were clear on that. All right, next one. Another softball for you, then we get into some more fun of math. Charging a rate of interest in excess of the amount allowed by law is what? Now, this should be the softball of all softballs. You should all know this one right off the bat. So which of the following is charging interest in excess of the maximum rate allowed by law? What do you guys think? I see. There we go. 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 Okay, you guys are getting it. Awesome. The answer is D, usury. I put this on the bottom of the slide there, if you'll notice. Some people have asked me what latches means. You might see that on your exam. It's not one that we get into very often. It is part of law, but I threw it in there just to throw you off for a minute because some people have seen this on their state exam. So what I did there is just put the quick definition for latches. It is not the answer, but it was answer C, and I get the question all the times, what does latches means? Or what does latches mean? It is failing to act in a timely manner, which results in a rejection. So basically, it's a concept of law that addresses a lot of things in real estate. So, for example, you'll have a statute of limitations that you have a claim to property. And let's say that you have 1 year for that claim. If you don't claim it in that year, then effectively what you've done is rejected it. It's not because you just outright rejected it. It's not because you said, hey, I don't want that thing. It's just your inaction. You not responding in that timely manner is effectively a rejection. So I just wanted to throw that out there. Has nothing to do with mortgages at all, but it's one of those terms that's like you read it and you go, latches, I wonder if that has anything to do with mortgages, and you question yourself. Like, man, I don't know if I know that term. Maybe that's what it is, and it's not. Stick with what you know. You guys knew the answer was usury on here, but latches is one of those terms that you will see on the exam, and it's just enough to get you to question yourself of, man, since I don't know what it is, maybe that's what it is. It is not. I just told you what the definition is, but more importantly, keep it in your mind. You already knew the answer. Don't let usury or novation or subordination, if you didn't know what those were, any of them throw you off. Stick with what you know. So that's why I wanted to put that out there. All right. Next question. You will likely see one very much like this on the exam. It may not be exact, but it'll be very much like on your state exam. It's a little, a concept that a lot of people miss. So a lender will make an 80% LTV, loan-to-value loan on a property that appraised for $72,250. And the property sells for $73,500. If the borrower has saved $14,450 for a down payment, how much more will he need in order to make the down payment required? So we could work through this. I'm just going to give you the answer here in just a minute. But I want to make sure that you're paying attention to a couple of things. So this deals with a loan, and what I meant to say, this is dealing with a purchase of a property. You have a borrower that is purchasing the home for $73,500. But they are buying the home and they got an appraisal, and the appraisal came in what we would call in the real estate industry as a low appraisal. The appraisal or the property was appraised for less than what the home was being purchased for. So the buyer has $14,500 to save for this. How much will they need? Here is the calculation. What we're going to do is we're going to take the amount that the amount that the lender will borrow against. They're going to borrow against the lower of the appraised value or the purchase price. So in this case, they are going to loan on $72,250. So that is the lower of the two. We do not, in this question, use the purchase price. It's normally that's what we would do, but because the appraisal came in under the purchase price, lower than the purchase price, we have to use that appraised value. So we take the $72,250 and multiply it times 80% there, and we get $14,450, which is great. Hey, look at the question. It says the buyer has saved $14,450, so the answer is obviously B. They don't need any money. But wait a minute. Just because the lender says we're only going to loan money based upon the appraised value, you still are buying the home. There's a balance that's still due. And that's why the answer is $1,250, because the second part of this is that because the sale price difference will need to be made up, we need to take that $73,500 minus the $72,250 to get the $1,250 that you're going to have to pay. So the answer here is $1,250. So it's the difference between the appraised value and the purchase price in this calculation. You have to make up that difference. So in this case, we're talking about two different things that are happening here. We're talking about the purchase. So the buyer and seller have agreed that the buyer is paying $73,500 for this home. So that's the first thing. We have to come up with that money. I'm paying you $73,500. But the lending side of this, part two of this, the lender says, well, we're basing our loan on the $72,250, on that lower amount. So we dealt with that. We know that we have the $14,450 to cover that for the lender, but I still have to reconcile that with the seller. And the seller says, well, I still want my $73,500. I don't care what you and your lender are doing. Make up the difference. So that's where the $1,250 comes in, is that the buyer is making up that difference. They're saying that I'm buying the home for you for $73,500. It's not, I'm not buying it for $72,250. That's the amount that I had to come up with for the loan. But for the purchase price, which is the other piece of this, that's the difference. So make sure you watch for that. Take a screenshot of this, save this. You will see something like this again on your exam. Almost promise you, guarantee it. Now, here's the last one. And this one's really going to twist your head a lot. So work with me on it. This deals with the mortgage factor chart. So here's the question. A buyer is getting a fully amortized loan for $220,000. The bank will give the buyer the loan for 15 years at 5.5% or for 30 years at 6.5%. To the nearest dollar, what is the difference between the monthly payments for these two loans? Now, again, we have not talked about this yet. Some of you already have this. It is what is called a mortgage factor chart. And I'm not expecting you guys to be able to read this, but if you're in my classroom, you have this. You have this already. Some of you might be saying, I don't have it yet. You have it, I promise. So you'll need this mortgage factor chart. When you go to take the state exam, they will give this to you. So don't worry about memorizing it. I just wanted to point it out that it exists, that you know that it's there. If you don't have this, if you're not one of my students, if you don't have this, email me. Email me, brian@reep.com. If you're not one of my students, you don't have this, you should have this. You need to know how to use this mortgage factor chart. It is very simple to use, but you'll need to know how to use it. On the state exam, however, you can't take this with you. You can't take this with you. They will have it for you. It'll be on the screen. They'll give you the numbers. They'll help you through it, but you still need to be able to read it. So just making you clear on that we need to have this in order to answer this question. And if you're in my class, you already have it. If you're not in my class, I will email it to you. And then also when you take the state exam, they will have it for you. So don't worry about it. So you need to have that. So what we're looking at here is, again, two different loans. So we have the loan amount. We have the loan of $220, and we have two different loans here. So we're going to work through how we calculate it. And I'm just going to skip to the next screen to show you how to work through this. So here it is. So using the mortgage factor chart, we're going to do a couple of things. Again, I know you probably can't read this, but at the top of every mortgage factor chart, it has the rate right here. You guys see where it's, maybe you can't read it, but it has a rate column right here. Then it has a term on it. It's either 15 years or 30 years. So I'm going to look. So the first question, or first part of this says it's 5.5% for 15 years. So what I'm going to do is go down my rate column, look for 5%, or 5.5%. I see that. And I looked at it's a 15-year mortgage. So I go over there. And again, I know you probably can't read it, but right there it says 8.17. That's what that column is. So I'm in the 15-year column, I'm in the 5.5-year row, and it's 8.17. That's where I'm getting that from. That is from this chart. So what I'm doing to calculate this is that I need to know how many thousands I am borrowing. To use this chart, I have to know how many thousands I am borrowing. And that's what we're showing there on the screen, is that I'm borrowing 220 thousands. It's $220,000 that I'm borrowing, but I am borrowing 220 thousands. So I use that number 220, multiply that from the factor chart that I just showed you of 8.17, and that gets me a payment of $1,797.40. So hopefully that makes sense. The mortgage factor chart is very easy, but you need to follow the principles that we're looking at the rate column, looking for that row for that particular rate. We're looking at the 15-year or 30-year column to come up with that 8.17 factor. And then we're applying that to the number of thousands that we're borrowing. So the second piece of this is easy, saying we're also looking at a 30-year loan at 6.5%. So the 6.5% row with the 30-year column gives me a mortgage factor of 6.32, which is there in that second part. I'm still borrowing 220 thousands. So I take 220 times 6.32 from that factor chart, and that gets me a payment of $1,390.40. So the question then asks, to the nearest dollar, what is the difference between those two mortgage payments? Well, for the 15-year mortgage, my payment was $1,797.40. For the 30-year mortgage, it was $1,390.40. I subtract those two, and my difference is $407. That is the difference in those two payments. So my answer in this equation is B. So again, a lot there. I know there's a lot there, but stick with the very simple principles of, first, make sure you have that mortgage factor chart. You have to have it in order to work through any of these questions. On the state exam, they'll give it to you. I have it for you. All of my students, you already have it. So again, if you can't find it, you're overlooking it. We'll talk about it in class. If you're not one of my students, you don't have it, email me. I will get it to you. And again, on the state exam, they will give it to you, but you have to have that factor chart. Know how the factor chart works, where you're looking for the rate and you're looking at the 15 or 30-year column. And then remember that we're applying that factor to the number of thousands. I'm not multiplying. I am not multiplying $220,000 times the factor. I'm applying the number of thousands that I'm borrowing, which is 220. I'm borrowing 220 thousands. So I'm 220 times that factor, and that's what gets me my calculation. So that, my friends, is how you will work through those numbers. So that is all that I have for you today. I know that I have blown your mind. I know that that's plenty to go through. And again, as I warned you at the beginning of this webinar, you are going to have to know all of this. You're going to have to know all of it. There's going to be a lot of questions on your exam, variations of what we just seen. But just talking to previous students, talking to people that have taken the exams already, these are questions that you will see. Again, maybe not verbatim, but you'll see ones just like them. So make sure you know how to go through them. Make sure you understand how to calculate the payments that we just did, because you will see them. Promise you, you'll see them. So if you have anything or if you're not sure about it, reach out to us. We'll be happy to help you. We just talked to our web developer today. I think our website's finally getting released today or tomorrow. Certainly our podcast, we just had a podcast about this. We're talking about that there. Just trying to get you as much information, helping you every way that we can. If we could do anything else for you, please reach out to us. We are at ahareep.com. I am Brian, B-R-I-A-N, at ahareep. Please like us. Please share. Please just do everything. Love us. We want to be loved. We need the love. We don't have enough love. No, just share the word. We want to get this out to everybody. So appreciate those likes. Appreciate those comments. Facebook, on Instagram, YouTube, all of that. Appreciate it. So that is it for me today. If you have anything, reach out to me. Take care, guys, and have a legendary day.